Thanks, James. Good afternoon, everybody. Hope you're going well and you've enjoyed today, soaking up all the insights that are on offer. As James just pointed out, we're here to talk about ESG discussions with your clients, and I'm joined by two wonderful panelists who I'm going to ask to introduce themselves.
Thanks very much, Tom. My name is Yousif Mohammed. I work for JP Morgan's payments business. What that means is basically it's the business that supports our corporate clients around cash management, around liquidity, as well as around trade solutions. So I head up trends and advisory in EMEA for this business, and I also globally lead our ESG advisory practice for payments.
Good afternoon to all. Hopefully everyone's awake and got a cup of coffee. My name is Nikhil Chouguley. I'm the Global COO for Sustainable Investing at Citi, private bank. And in that capacity, I've had the pleasure of building a new ESG data lake. Using that data lake, applied a whole bunch of regulations, internal best practices to classify products, whether they're sustainable or not. And using that information, matching that against a client's questionnaire. Clients under EU law have to express their preferences. And what we're doing is using data to classify products, and those products are matching against the client's preferences. So effectively, I've had the pleasure of building that ecosystem at Citi and deploying it globally. But in a general capacity, I've been working in private banking. I was at Deutsche Bank prior to this. And I got into the ESG space 10 years ago where I created a private equity fund that was investing in agroforestry assets. So, ESG has always been there or thereabout. It's just that we have a regulatory framework and a lot of good technical infrastructure to deploy that regulatory framework on. So that's basically what I'm doing, deploying sustainability ESG across Citi to meet regulatory needs.
Thank you. And I think just before we delve into the discussion, just a bit of housekeeping, reminding the audience members to submit questions via the Brella app if you've got it. So from the homepage, you click the top left part of the screen and then select Q&A. And I'd also invite audience members to think during the session where you've had good, bad, or ugly sustainability conversations in the past. We'll probably have a bit of a window at the end of the session for anybody to share any experiences, which I think could be helpful for the audience members. So without further ado, we can dive into the discussion topic. So the first point is around what are your clients' biggest ESG priorities and challenges when it comes to interacting with a financial institution? So I'll go to you first, Yousif.
Thanks very much, Tom. It's a great question, and maybe I'll sort of frame it in terms of the clients that I tend to deal with on a day-to-day basis in a JP Morgan payments capacity. So we typically work with multinational corporates, and you may have heard this theme already, but it's important to reiterate. But wherever those MNCs are headquartered, a typical MNC will have operations across 30, 50 jurisdictions, sometimes up to 100. And so the first thing that they tend to have to grapple with is the ever-evolving set of regulations that they need to comply with. That is something that, historically, as we've seen, I think you've heard this already, Europe has taken very much a first mover kind of approach to, but we're really starting to see those kinds of regulations, whether it's around disclosure, whether it's around compliance, to really multiply across different jurisdictions. So the very, very first thing is that kind of making sure that they stay up to speed, and they often look to their banks and global banks to support them and give them that sort of support and help them comply. Now, the second piece when it comes to their interaction with banks is, we hear the term taxonomy a lot when it comes to regulation, but one thing that we find that clients also grapple with and find as a challenge is the taxonomy of ESG products and solutions that are offered to them by their various banks are not necessarily fully aligned. And so they kind of need to wade through another alphabet soup when they're dealing with 2 or 3 different banks. So I'll give you an example here is deposits. Now, this is a space where we've seen quite a bit happen. Some banks are offering green deposits. Some banks are offering ESG-linked deposits. The actual structure, the impact, what it actually does for the client can differ in quite fundamental ways, but it really needs to look below and beneath the label in order to kind of understand that. So that's something that we really think that banks kind of can achieve a bit more consistency around in order to make life easier for their clients. And then the last piece I'll talk to is how do you actually make ESG strategy relevant to different parts of the business? So in my day in, day out, when I speak with clients, I'm typically speaking with executives in the finance division, in treasury, in procurement. And the question often is like, okay, we know what you're doing from a bond side of things. We know what you're doing on M&A from a supporting those kinds of transactions. What can you do as a bank to support me from a treasury and cash management standpoint in order to achieve and align with the objectives that my board or my CFO has set for me? So those really the three things that I've seen consistently in terms of client challenges.
Okay, Nikhil, have you got anything to add to that?
So, similarly, I would say I have to set the context because I work within the wealth management organization, and that is people like you and I. It's the end retail investor that is my client. And these are complex beings. They've got emotional as well as financial as well as sometimes irrational decision-making processes. So you really have to understand what are the client's preferences from a sustainability perspective. But at the same time, what good is having a really sustainable portfolio that has not delivered the necessary returns of investment? You've got the most carbon neutral investment portfolio and you've retired with a 30% deficit. There's an element of suitability. And in my case, there is a pecking order, there is a hierarchy. You have to involve the client, understand their needs, objectives, understand their risk and time horizon. These are all suitability framework criteria. That is paramount. And with that as a primary guiding force, and it sort of contradicts what our previous panelists were saying, but from a wealth management perspective, you have to find products that are suitable for a client and also meet their sustainability needs. And this is not me saying this out of the goodness of my own heart. You've got an EU regulation called MiFID ESG regulation that sort of sets this hierarchy. So effectively, clients are retail clients such as you and I. We invest, we've got financial needs, we've got retirement needs, we've got attitude to risk, we have sustainability preferences, and sustainability preferences are now part of this framework. So that is sort of the opening statement. But to help a client understand what are their sustainability preferences, you've got to go back and educate them. You really have to break down what is an ESG as a risk concept. To me, terminology is very important, and as the industry evolves, we will have to start defining this kind of nomenclature. So first part is helping the client understand that there is a fiduciary obligation on us as a wealth manager to understand the risks that are embedded within a financial instrument. And this financial instrument not only carries financial risk, market risks, but also is carrying a risk because of an environmental, social, or governance factor. So we have a fiduciary obligation to understand the risk parameters associated with the product that we're offering to the end customer. The other part is the sustainability or the double materiality part, the impact part. We also have to understand that, and there are frameworks in place as defined under EU law, UK law, and these look at positive contribution, these look at harm, and these look at various internationally recognized frameworks to define harm and positive contribution. So again, there's an element of knowledge sharing with the end customer. You really have to help the customer understand that ESG and impact are not one and the same. There is a risk element and there's a disclosure and transparency element. And then the third element I wanted to bring into this is, there is, you've got to know your client, you've got to understand, help them understand and educate them, but actually there are downstream dependencies on the flow of information. So we're in a very nascent stage as far as the industry is concerned. We as a end distributor, we're hit with laws, we've hit with client disclosures. We are dependent on product manufacturers. Product manufacturers in turn are dependent on data providers, and data providers are in turn dependent on corporates to provide that information. So this supply chain, this whole value chain at the moment is not fully developed. And actually, from a timing perspective, it's the cart before the horse, because we as a financial institution have to disclose to the client what is the sustainability impact, what is the risk parameter of their portfolio, of a certain fund, of a certain security that they're holding. But the information that we need to be able to perform this regulatory activity is not necessarily available in a standard, in a format with the right level of granularity and rigor that we expect. So we have a dependency on the corporates to provide the right information in the right format, and I believe it's going to take another 3 years for that to truly settle itself. So unfortunately, the answer is not that simple. To serve the client, I need to look at the corporates, and those corporates need to report data under different formats, CSRD format, TCFD, and there's a huge alphabet soup of other formats. So key note here is dependency on corporates, educating the customer, and once we have these foundational building blocks in place, we can then understand the client, understand their needs, subject to meeting their suitability criteria first, and then meeting their sustainability preferences next.
And I think it's important to recognise whether it's retail investors or whether it's global corporates. Lots of people this is a spectrum of understanding of ESG, which everybody is at a different point at, and it's important to sort of recognise that and identify that with your clients. Now, I think technology is clearly a supremely important tool for customer conversation. So, which technologies do you think are the most effective to enable organisations to showcase their ESG data reporting and/or strategies?
So, whilst I'm not a technology IT person myself, I think technology per se is sort of a secondary footnote in this whole process. I think that there are technologies available in the world to capture data, to create data. So we're not really, ESG doesn't really demand a new technology paradigm as such. You can deliver ESG, data lake, rules, client preferences on the current technology stack. So you don't need new pieces of technology. But the reality is it becomes expensive. So the current technology stack, whilst it delivers the minimum regulatory requirements, ticks a few boxes, has an all-right-ish client experience, there is a need for innovation and actually reimagining the technology stack. So I would say, let's break this question into 3 parts again. One is client. Can we use behavioral finance? Can we use these kind of, almost science and psychology and human psyche, combine all these using behavioral finance to truly understand what are the sustainability preferences and the risk appetite of a customer as part of one know your customer package. That's one piece of technology-led innovation that I see. The next part is product classification and data. Again, machine learning, AI. I've already met a lot of great organizations here who are trying to use that technology to deploy this and come up with the right data sets. So again, I would welcome that. The third part, in my opinion, is traceability and auditability of data, right? There are a lot of players. If you look at the question from the perspective of the end of the corporation, right, listed or private company, they're being hit by from multiple sources to provide the same information, right? They're getting maybe 10, 20, 30 questionnaires with 60 pages each of, organizations asking them for the same information. So what I'm proposing here is maybe there's a use case for using blockchain to ensure that you create the data once. The traceability and auditability of that data lies with the creator of that data, which is the end investee company. And you centralize and harmonize the data infrastructure. So I would say in terms of technology and innovation, I think there is scope for the application of 3 technologies, depending on whether it's the client, then I'd say behavioral finance. If it's product and looking at the risk and impact aspects of a product, then I would say AI and machine learning, and then maybe even quantum computing in the future. And if you're looking at dissemination of data, avoiding duplication, avoiding latency, avoiding concepts such as misrepresentation of data and liability, then I would strongly recommend blockchain.
Okay, Yousif, from your experience, you have anything to add to that?
Sure, happy to. So, Nikhil, I think you covered it quite nicely in terms of the impact of AI, blockchain, and these kind of emergent technologies and the potential that they carry. I kind of want to bring in an angle that's a bit more of the sort of bread and butter of technology that we currently have, we're already using in other aspects and it's very mature in certain ways. And I think we can deploy in an ESG context to really unlock certain kind of benefits. So one element, and I think you've already talked to this, Nikhil, is the integrity of the data. So think of the corporate as a unit of analysis and producing sort of think of disclosures. So one thing that we have talked to some of our clients is, think of an oil and gas company that is undergoing a fundamental shift in its portfolio into renewable energies, but it still fundamentally has a legacy portfolio and payment flows that are relevant to their oil and gas piece, but they're also under the same kind of legal entities, under the same corporate. They're also pivoting, and they're making investments in wind farms and solar, et cetera, et cetera. So one element that's really kind of emerged within the transaction banking space has been around like virtual accounts, and how do you actually use virtual accounts and ledgering and reconciliation systems to make sure that in the normal course of your business, you're actually generating and capturing the data that is relevant to your, the green side of your business that you're investing in. That is a much better way. So you're organically hardwiring those sorts of flows and transparency into them early on, as opposed to try to look at headlines at the end, sort of in terms of the accounting, and then try to backward calculate certain aspects or apply certain keys and what have you. So that's one element we think that we've seen virtual accounts uptake quite a bit in different contexts. There's value on the ESG space. And then another piece, and I think you kind of hinted at that earlier, Nikhil, is in terms of the sharing of the data and how do we make sure it's available. You have different data lakes that are in existence. So take a simple example of ESG ratings. How many providers are there? Countless. If I'm sitting in if one of my clients is sitting there, do they have one source where they can actually pull together if they're looking at a particular company that they might be doing business with, looking to acquire, whatever that might be? At the moment, they might have to go log in and out of different sort of platforms in order to kind of, pick different pieces of information. If we can use APIs, if we can use kind of cloud and that sort of infrastructure. And again, you need to get the industry aligned to make sure that those APIs are a bit more standardized, the same way that they have been in an open banking context. That, I think, will end up making the environment a lot more sort of conducive for corporates, conducive to individuals to make decisions and take decisions.
And are you finding when you're having conversations with clients, that's the feedback you're getting, that's a pain point that clients have been vocal about with you?
It is. And oftentimes, I've been in conversations with clients that weren't aware that a particular rating agency was actually covering them. So that level of the lack of transparency sometimes is something clients might come at it and say, this is a problem statement I have, but sometimes in the course of the conversation you realize that they're aware of one or two of the major providers and how they stack up within those providers, but not necessarily with others. And then the other pain point is not necessarily when it comes to clients' own ratings, because they tend to be relatively well aware of those at senior levels. But when they are looking to onboard suppliers, so again, part of our business is trade, supply chain, etc. Supply chains and Scope 3 emissions are, go hand in hand, because that's fundamentally what Scope 3 is measuring. And so clients do not have a useful and easy to use tool necessarily to just say, pop in the name of a tracker or of a particular company that might be in their supply chain and have a golden source of information across not just the ratings, but other material issues and KPIs that are relevant to them.
Okay, similar story with the clients that we're engaged with. And I guess on that topic of transparency, what advice would you give to an organization looking to improve the transparency of their ESG communication strategy?
There's loads of things we can talk about. I think I'll try to keep it brief. The first thing, and again, this really depends on the sophistication of particular organizations. And we heard earlier from the earlier panel that because of I think the word used was like shifting goalposts, right? So a lot of companies, they're basically trying to run to stand still just to meet the regulations or under disclosures and so forth. So let's assume that's done, and let's assume that's going to be taken care of. How do you actually move in terms of your level of ambition of how you communicate your ESG strategy? I think one thing is to make it very, very clear that this is your story around ESG is not a story around CSR. So tie in your ESG or sustainability, whatever label you choose to go with the core and the strategy of what your business is. I think that's very, very key. And oftentimes, as much as that gets said, we oftentimes, inevitably hear people talking about it's less about the core business and more about planting trees, and it's separate from what they're actually doing. So that's a key point to establish up front. The second point is around figuring out who your stakeholders are. Who are you actually looking to communicate to, and the language that you're going to use is going to vary by that. So if you think of like concentric circles, initially you'd be thinking, shareholders, investors, you're thinking around your employees, you're thinking around your customers. But then kind of you go further out, you might be thinking around different types of stakeholders who need to hear your ESG story, understand your strategy a bit better. Some of them might be suppliers, some of them might be buyers of yours, some of them might be companies you might be looking to acquire down the line. So have an expansive view on who your stakeholders are, what nomenclature works for them, and then kind of tell your story accordingly. The third piece, before I hand over to Nikhil, is, and you mentioned the term materiality, figure out what are the material issues to your sector. A consumer and packaged goods company is going to have a very different set of materiality and double materiality issues from an ESG standpoint that all of those stakeholders that I just talked about, or not all of them, but a majority of them, will be thinking about this is going to be very different from an automotive company, and that's going to be different from a pharmaceutical company. So be educated and make sure you have a full understanding of how rating agencies look at your industry, how peers within your industry, and sort of what the best practice is. And as a result, you need to kind of distill 5, 6 kind of discrete KPIs, discrete variables that you're going to hold yourself accountable to, publish your whatever your targets are, make sure you're tracking them, reporting them. And last but not least, I said 3, but I'm going to add the 4th one, is the governance piece. Make sure this is owned from a governance standpoint at the highest levels of the organization, because otherwise it will just kind of fall over. Okay.
I mean, what a great answer. So comprehensive and really looking at the stakeholders and the complexity of the ecosystem where sustainability applies. It's not just a standalone piece. Sustainability, ESG, is something that is intrinsic and embedded and needs to get into the cultural DNA of organizations. But building on from what Yousif just said, and trying to apply, transparency in a client context. So again, let's look at retail clients such as yourselves and myself. So and again, different countries are different stages of evolution. Had we been having this conference in, let's say, Luxembourg, I would have been using MiFID ESG as the frame of reference. Because we're in London, I'm going to talk about UK SDR as a frame of reference. Again, let's not get caught up by the alphabet soup of acronyms here. But effectively, retail customers wish to know, has my portfolio performed, has it generated return of investment? That's what they primarily care about. But if you look at research from UK industry bodies and some other European industry bodies, 70% of customers are actually interested in the concept of not doing harm and not having a negative impact. So they're keen to avoid certain themes, certain sectors, alcohol, genetic testing, things like nuclear, controversial weapons. Okay, these are sensible filters. But the reality is, if everyone starts to select against these companies, you will not be able to engage with them. You'll not be able to use your capital as a push factor to help these companies transition and change their behavior, change the way they use resources to generate wealth. So the reality is, exclusions, while it sounds nice and simple, and that's something that customers understand, can actually be a dangerous tool, because the sustainability transitioning agenda can be completely lost. These companies that can no longer access capital from mainstream investment houses or mainstream investment banks will take their financing needs into the private debt market, and who are not necessarily applying sustainability principles. So the opportunity to engage will disappear. The opportunity to use your influence as an investor, as an institutional investor, will disappear. So it's very important to understand that exclusions, while it's simple, clients understand that. You apply nice screens, revenue-based screens, it doesn't really work. Clients are also interested in knowing about positive alignment. So we have a concept called Sustainable Development Goals. Very nice. UN has created those. But again, it's really difficult to take a company, a product, a fund, and map it to UN SDGs. How is this company and this fund contributing to SDG 13, which is climate action? How does this particular product contribute towards hunger reduction, poverty reduction? So we don't have internationally recognized standards in the world. While some data organizations are doing a great job, clients like this as a concept. Again, it's difficult to communicate. And something that is difficult to communicate, and you have communicated to the customer, you're carrying the liability for mis-selling and mislabeling and misrepresentation as a bank. So again, we're in a bit of a fix. And the third element I wanted to add here is the concept of EU taxonomy, right? This is a very pure EU regulation-defined concept where around 1,000 odd industrial activities have been mapped to NACE codes. And against each of these NACE codes, you have a parameter which says if you're in the business of producing electricity, right, it needs to be less than 100 grams of CO2 per kilowatt hour. If you're in the business of producing a sustainable housing product, then you need to ensure that you use less than 7 milligrams of formaldehyde per square meter of paint. So that's the kind of technicality that exists. So the reality is transparency is a very difficult and a very nebulous concept in the end result, in the end client space. We're trying to learn, we're trying to source data, and we're trying to be very careful about what level of transparency we can provide to the client. Whilst there's a need, there is no recognized framework that currently exists. But that is not basically admitting defeat and saying, okay, we can't do anything until someone comes up with the regulation. So I would say for now, to provide clients with the right level of transparency to be able to see how their portfolio, investment portfolio is performed, we can use the concept of principal adverse impacts. This is an EU regulation-defined concept. There are about 18 to 20 KPIs. Data in this space is developing quite nicely. So enable clients to understand how their investments have performed, whether they've had what is a carbon footprint, what is renewable versus non-renewable energy that's been consumed, whether any companies in your portfolio that are breaching UN Global Compact, are there any companies that are actually involved in controversial weapons, looking at gender pay, looking at board diversity. So there is enough information here that clients are actually interested in, and you can start reporting and providing transparency at a portfolio level, at a security level, using the concept and the framework of principal adverse impacts. So that's how the retail space works. The institutional space, well, I mean, actually, institutional and family office clients are willing to give up short-term returns from oil and gas in return for transparency on how they've made a positive impact. They define their own parameters to say, we have an objective as part of our family office, a philanthropy organization, to really champion reducing hunger and poverty. So look through our investment portfolio and give us a report on which companies are actually contributing towards food, towards agri-tech, towards minimizing food wastage, so on and so forth. So depending on the nature of the client, the transparency paradigm changes. Family offices get bespoke reporting. They define their own parameters, and it's possible to provide that kind of one-to-one bespoke level of transparency. Retail clients, not so much. But it's not a lost cause. There is data, there is regulation, there is standardization. What we can begin with is just looking at the negative impact a portfolio can be having using the concept of PAIs. That's how we provide transparency.
Thanks. I think Nikhil and Yousif both mentioned KPIs and the importance of transparency of KPIs. You've got 3 banks on the panel. When banks are entering into sustainability-linked financing and you look at KPIs, it's really important to have transparent definitions around how you're measuring the KPIs, and then very transparent on your ongoing performance when you're involved in KPI-linked financing. We have had questions that have come through as we've gone, but I did say at the start we would canvass the audience as the 4th panelist to see if there was anybody that was brave enough to share any experiences, good, bad, ugly, war stories, or otherwise from conversations that they might have had with financial institutions. So I'll just pause, and if there is a sea of hands, there will be. If there isn't, we'll continue with the questions. We've got one at the front.
Thank you. So I sit on the council for a university, and we're just going through the tender process at the moment for our investment portfolio. And it's been really interesting as part of that. to hear from the various asset managers that we've been speaking to about their ESG offering. It was a significant part of our RFP to them. And they all actually did a really good job of talking about it to varying degrees. But so I would say my experience has been really positive, albeit I think the asset management industry is kind of used to these conversations now, particularly in the sector that I'm in that respect, which is universities, where obviously this is a very important topic for the students. So a good experience for me.
Okay, and just on that, I guess, so we, as an organisation, we've seen RFPs from similar institutions, and I think your RFP process, I guess that's changed over time. And can you remember a point in time where this became a key decision criteria when you were speaking with financial institutions?
So I wasn't part of the previous tender. It was before I joined, so about 5 years ago. It was a component because the university in question is a veterinary college. So they already had conditions around things like animal testing, and they had some of the standard stuff around gambling and defence and so on. But this time around, it was a really significant element, and we asked a lot of questions about how the competitors would meet our specific ESG requirements. So it was a big difference from what was probably last done about 5 or 6 years ago.
Okay, thanks for sharing. Is there anybody else that would like to share? We can drop into the questions. Well, we might present another opportunity as we go through. So a question has come in for Nikhil. You mentioned client education around ESG is important. To what extent are you seeing clients actively asking about sustainability? Is it push or pull? And how mature is their thinking around risk, impact, disclosure, or how open to learn?
Wow, huge question.
Sorry, I should have broken it down.
Just trying to break it down. So in terms of just high-level numbers, right? Research suggests around 70% of clients are interested in ESG. When you start explaining to them, actually, there is not enough data, and therefore there are not enough products, and therefore we cannot necessarily sell you anything right now, the interest dies away. Sadly, that is where we stand at the moment in 2023. Had we been in 2026, where the data ecosystem, as I'd mentioned at the start, had the data ecosystem, the wheels would have been turning nicely. That means the product manufacturers are confident that the products that they're creating and labeling as sustainable, as thematic, as impact, with an element of risk from environmental, social governance issues, then the risk of greenwashing would be significantly mitigated because there's an underlying methodology, data ecosystem that can be trusted, relied upon, that is standardized. Then we would have had a much bigger product suite. So there is tremendous client interest. And I completely agree that the number of 70% is indicative of the industry as it currently stands. But when you actually look at what is available on the product shelf that truly meets a double materiality framework, if the product's got sustainable in its name, has a methodology with binding commitments, with a certain clear reference to a certain industrial activity, with a certain piece of technology, with a certain industrial process, there are very few products that can actually do that. So, and as a result, client interest, in my opinion, drops from 70% to only 5% say, yeah, actually, give me a product. I'm happy to take the chance. Give me a portfolio which has got sustainability objectives. So, unfortunately, there is a bit of a pull and push factor. Whilst there's client pull, there's regulatory push. The reality is the rest of the ecosystem's not there to supply the needs of banks, financial institutions, product manufacturers, asset managers to meet the client's needs at the moment. So that percentage of 70% drops down to 5% in terms of how many are actually willing to put their money in a sustainable investment. I would expect this number to change dramatically in 2026. Why? CSRD, it's a EU law that pulls EU taxonomy-related information into corporate disclosure. TCFD, again, climate-related financial disclosure. And a number of other, Asia and US-related regulatory mechanisms are also adopting climate risk disclosure as a key pillar. So I would expect by 2026 we have a better data ecosystem, therefore we have a better product classification and disclosure ecosystem, and therefore we as distributors have got more products that not only meet a client's suitability and return of investments needs, but also meet a client's sustainability needs. So that number will improve in the future.
And I think obviously that question was around client education. I think on the panel before.
Sorry, apologies, I forgot.
No, not at all. I think on the panel before, my counterpart from Lloyd's mentioned it's also internally for big organisations to have sort of capability within their staff. So this is a relatively new concept for many of your financial institution counterparties and the staff. So I think it's also a key consideration to have that internal capability. I don't know if you had anything to add to that, Yousif.
No, I just want to echo your point, both of your points. I think one of the lack of kind of certainty is creating a certain amount of risk for financial institutions, and as a result, and greenwashing risk effectively, and we can't really move the needle until we have a lot more clarity. So from my perspective, where I sit, I deal with corporate clients, so the suitability conversation isn't as much of an issue because you're oftentimes dealing with very sophisticated treasurers for multinational companies, so that's not going to be an issue. But then the question is, what do you label as an ESG solution? What actual impact does it have? We've seen quite a few products launched in the market over the past few years that have an ESG label, and actually when you dig underneath, it's basically a pricing mechanism, and you're giving the client a pricing bonus of some kind or a discount based on them meeting X number of KPIs. Is that greenwashing? Unclear. Because if they're going to meet that anyway, are you really incentivizing behaviors, or are you just taking a really low hurdle rate, they clear it, and then they get a bonus or whatever that might be? And so in order for us to move away from that kind of approach, and I do think we absolutely need to do that, we need to move into much more of a double materiality approach, but also impact-driven approach that really raises the bar on what is expected, and also is something that you can compare and track across the life cycle of any given product. And at the moment, we're not there yet, but I think that's something that the industry really has an incentive to kind of collaborate, work with clients to make sure that we get on that path.
Well said. I mean, just to sort of round off the part that I forgot to answer, so apologies. I think client education is a key part, but I think before we get to client education, banker and financial services professionals, we need to get educated. So I think that's how the narrative will change. At the moment, there are still too many doubters. We think, is ESG actually a value-adding activity or not? I think it's a risk management discussion, and that's what we should focus on. Educate ourselves about what is the underlying embedded risk. And as bankers and product staff learn to speak the language of sustainability, clients are naturally engaging with these people. They will start also figuring out what is the risk associated, what is the impact associated, and what are the different globally acceptable methodologies available to start measuring this. So I think client education is secondary. I think what the primary need that lies in the industry is training ourselves as financial industry professionals, speaking the language, not just at a peer level, but also educating the board, helping them understand that this is a senior manager risk liability that you're carrying, and under various regulatory functions, you'd be held accountable by the regulators for the culture, for the governance, the education not being fit for purpose from a sustainability perspective. So there's an element of educating the board of organizations, there's an element of educating the bankers and the staff of an organization, and also the control functions and developing that. And once this part is sorted, the natural outcome, at least in a private banking world, is clients will also start understanding this, because all client comms, all engagements between the banker and the client, any interaction between them from a technology or a UX perspective will have an element of sustainability messaging, sustainability education, double materiality, risk. These concepts would constantly be fed to clients. And over the next 3 years, that's the journey that we're on. Educate ourselves as bankers, and in the process, educate our clients. And then I think sustainability, at least in Europe, would be a mainstream concept.
Thank you. Time has crept up on us. We've got 45 seconds left, so I am going to wrap it up. We've had lots of wonderful questions. So firstly, thank you for the participation and the live participation as well. And I will say thank you to both my panelists for joining for an interesting debate. And if there is any questions, obviously we're standing in between you in a networking break. If there's other questions that you'd like to follow up with us, please do grab us in the breakout room. So thank you.